Welcome back to The Explainer. Today, we are looking at something that affects literally the entire foundation of our economy. But honestly, it's usually buried in thousands of pages of incredibly dry, sleep-inducing legal code. We're going to break down exactly how some of the most profitable corporations on the planet manage to shrink their federal tax bills down to, well, near zero. You know I love taking these massive, complex systems and making them crystal clear using data. So grab a coffee, get comfortable, and let's get into it.
Okay, let's dive right into this. How is it mathematically and legally possible for a massive corporation generating billions in profit to pay absolutely nothing in federal income taxes? Today, we are strictly focusing on the data and the actual mechanisms. Specifically, which exact loopholes do businesses use to legally avoid corporate taxes? Let's take an impartial look at the hard facts. Here is our roadmap to map this all out. We'll start with the 0% phenomenon, then tackle bypassing with pass-through entities, offshore havens and profit shifting, depreciation rules, the role of political spending, and finally, historical context and reforms.
Section 1. The 0% phenomenon.
Before we get into the how, we've really got to establish the reality of what's happening right now. Looking at some fascinating data from the Institute on Taxation and Economic Policy, or ITEP. Look at this tiny number, 0.4%. According to ITEP's analysis, that was Tesla's effective federal tax rate on a staggering $10.8 billion in profits from 2022 through 2024. Despite being valued at well over $1 trillion, their total federal corporate income tax for those 3 years, just $48 million. It absolutely proves that the statutory tax rate, the official rate on the books, really doesn't always match reality. Now, what's really striking here is the sheer scale of that disconnect. Look at the left. There's the standard statutory corporate tax rate in the U.S., sitting at 21%. But on the right, a mere 1.8%. That was the average effective tax rate for 55 large, consistently profitable S&P and Fortune 500 corporations between 2018 and 2022. We're talking household names here. Bank of America, AT&T, General Motors, all paying less than 5% over a 5-year stretch. So the big question, how exactly do you bridge that massive gap between 21% and 1.8%? Well, let's look at the specific mechanisms.
Section 2. Bypassing with pass-through entities.
To really grasp how these loopholes function in the real world, we have to demystify a bit of legal jargon, starting with the pass-through entity. By definition, this is a business structure where profits bypass the corporate income tax entirely and are instead passed through directly to the owner's personal tax returns. Now, back in the day, if you wanted corporate legal protections like limited liability, you had to form a traditional C Corp and pay the corporate tax rate. Pass-throughs, those were mostly supposed to be for your local mom-and-pop shops. But, as you'll see, the rules of the game have shifted completely. Here's how this plays out in practice. Over the last few decades, new legislation has basically allowed these pass-through entities to get all the sweet privileges of a corporation without actually having to pay the corporate income tax. So today, you have massive global enterprises like Bechtel and Bloomberg operating as pass-throughs. The data actually shows that in recent years, more business profits are reported from these pass-through entities than from traditional C corporations. And because of their sprawling, highly complex structures, large pass-throughs are notoriously difficult for the IRS to even audit. It's basically a massive structural loophole baked right into the company's identity.
Section 3. Offshore havens and profit shifting.
Now, this next loophole is all about shifting numbers across borders, and I mean just the numbers, not the actual products. Profit shifting is essentially using creative accounting gimmicks to make it look like profits were earned by subsidiaries in zero-tax jurisdictions or tax havens rather than where the actual business took place. It is absolutely crucial to understand that this is largely an accounting fiction. A company isn't literally packing up factories and moving them to a remote island. They're just transferring intellectual property rights or maybe using internal loans to shift the paper profits out of the country where the real economic activity happened. And this data makes the reality of profit shifting impossible to ignore. Just look at the British Virgin Islands. U.S. corporations claimed profits there that equaled 126% of the entire jurisdiction's GDP. Think about that. That's literally a mathematical impossibility. A foreign corporation cannot realistically generate profits that exceed the entire economic output of its host country, unless those profits are just sitting on paper. Or take Ireland, where U.S. company profits equaled 105% of their tangible assets located there. But if you want to see the true, undeniable absurdity of this scale, check out this number. 1,000,000
$303,916. That is the exact amount of profit U.S. corporations claim to earn per single employee based in Bermuda in 2022. I mean, no way, right? It proves beyond a shadow of a doubt that these aren't just exceptionally productive island workers. It is a massive, completely legal accounting maneuver designed specifically to dodge domestic taxes.
Section 4. Depreciation Rules and Accounting. Our third major loophole relies on purely domestic mechanisms, ones that have been significantly expanded in recent years: permissive depreciation rules. So, in simple terms, when a company buys equipment, it loses value over time, right? The tax code allows companies to deduct that declining value from their income. But accelerated or bonus depreciation rules let corporations aggressively deduct those costs up front, way before the asset actually loses its value. This legally shrinks the amount of profit they're required to report to the IRS, which, you guessed it, significantly slashes their federal tax bills. We can see the immediate impact of this by looking at the data right before and after the 2017 Trump tax law, which expanded these exact permissive depreciation allowances. For 16 prominent, consistently profitable corporations, their average effective tax rate dropped from 22% in the 2013 to 2016 period down to a measly 12.8% in the 2018 to 2021 period. And get this, ITEP data notes that while corporate profits for those specific companies actually shot up by 44% in that time frame, their federal tax bills dropped by 16%.
Moving on to Section 5, the role of political spending. So we've identified the how, right? The pass-throughs, the profit shifting, the depreciation. But why do these incredibly complex rules even exist in the first place? Well, according to research from institutions like the Brennan Center for Justice, they definitely don't just appear out of thin air. Academic studies by researchers like Brown, Drake, and Wellman have demonstrated a very clear empirical link between corporate PAC contributions and favorable tax policy. Their research concludes that firms who give consistently to politicians are likelier to pay lower tax rates. The spending is basically treated as an investment to secure influence, which then translates into highly specific, customized tax exemptions woven directly into the legal code. It's fascinating.
Let's see how this builds into a very predictable cyclical system. Step 1. Corporations use lobbyists and make political contributions. Step 2. In return, politicians often support or draft legislation granting special tax exemptions or favorable accounting rules, like those depreciation bonuses we were just talking about. In Step 3, the corporations use these new rules to legally save billions in taxes, which, of course, frees up more capital to continue the cycle all over again. It is a self-sustaining feedback loop of political finance and tax avoidance. Finally, Section 6, Historical Context and Reforms. Now, this debate over corporate tax dodging might feel like a uniquely modern problem, but history shows us it's actually deeply cyclical and often highly bipartisan. Let's rewind a bit to the 1980s, during the Reagan administration. Early tax cuts had severely hollowed out federal revenues, and in 1984, a path-breaking report came out revealing that 128 profitable companies paid zero federal taxes. This sparked massive public outrage. As the Wall Street Journal noted back then, this research helped propel a tax overhaul. President Reagan himself, actually alarmed by the deficit and the tax dodging, worked right alongside Democrats in Congress to pass the massive 1986 tax reform. It was a huge bipartisan effort, specifically designed to close many of the exact same loopholes that had just been opened a few years prior.
Fast forward to today, and advocates, along with some lawmakers, are proposing modern solutions attempting to replicate that exact 1986 success. These proposed reforms directly target the specific mechanisms we've outlined today. We're talking about things like eliminating those permissive depreciation loopholes, implementing a flat 15% minimum corporate tax regardless of how many deductions a company claims, adopting a global minimum tax to neutralize those offshore havens, and expanding the corporate income tax to finally cover those massive pass-through entities. Which leaves us with one final major question to ponder. What will the future of the corporate tax code actually look like? Will the historical cycle repeat itself with a new wave of bipartisan loophole closures? Or will that feedback loop of political spending and complex accounting keep effective tax rates hovering near zero for the world's biggest companies? It is a giant, fascinating systemic puzzle. Thank you so much for joining me for this explainer, and remember, always look past the headlines to the mechanics underneath. See you next time.